Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, October 15th, 2025. It's 10 o'clock on the button as I'm starting the video. Wanted to get one out today early. Been a couple questions put to me. I'm going to be partially offline today. I'm just wrapping up my taxes. Today's October 15th. That's tax extension day, putting the final touches there. Get that return off. Somebody asked about wheat. I'm going to get to the markets in a second, the VIX, everything else. Somebody asked about wheat. And wheat, it's still at that long-term support. So my reply, and you can check that on the front page, was look, these the big grains, wheat, corn, soybeans, they tend to trade in sync for the most part with one another. And wheat's still at that, what is that, 25-year, quarter-century long uptrend line that it's been testing for about the last year or so. So wheat just needs a kick in the pants to get going. But it's a dead money trade. Like I said, the better fish to fry elsewhere. The long-term charts are still constructive. But you just got to get going here. Let me just show you what it looks like here. You continue to the ETNs, if you trade those. I think the question that was put to me, that person's trading wheat futures, the mini contract. But this is the 60-minute chart. And, you had a basing pattern here. You had to pop above R1. You never took it out. So you still have to get above that level. Wheat's been the same story for a year. It keeps just inching lower. Mainly, remember the ETFs, or this is technically an ETN, it's going to have expenses and fees. The futures kind of are holding those same levels for the last year or so, not going down, not going up. And I always watch corn and soybeans. They've been holding up better. Corn put in a low back here. And again, I'm just using the ETN because it's simple, CORN. Made a marginal new low, which is about an equal low in the futures, I believe. And again, it has to take out these overhead resistance levels, downtrend line, and this big T1 level back here. That's where we first put it on. Hit that first target, hit it again. And the same story with soybeans. So they, to me, it appears the downside's minimum. Remember, these are grains. They're not going to go to zero. They're not going to file for bankruptcy protection. They're not going to issue a share dilution, additional shares on the market. And but on soybeans, again, soybeans are holding up. SOYB continues to make these higher lows here, and like I said, they all tend to run roughly together. Soybeans and corn start to run. Wheat eventually comes up. They're competing, food sources. All right, so that's it. You just have to take out that T1 level there. If you break that trend line, you're probably going to go to a new low. It'll be a marginal new low. So again, these are, as I said, they don't spin off dividends. So if you're in them, it's a way to diversify. Absolutely. It's a completely different asset that's non-correlated to the stock market, but you're not going to get paid to wait. Speaking of that, I gave you an update on BIZD today. Like I said, and it's just me, I decided to just book quick profits. And like I said, I left these. These are the original. That was T1. That was T2. And so for those of you in there, you will get paid a nice fat dividend on this one. And it could be a bottoming play that plays out for months. So, if you take out T2, you're going to take out that downtrend line. You're going to keep going. This scenario is largely dependent on whether the stock market, even if we're going to hit T2, most likely depends on whether the stock market can shrug off last week's sell signals. I'm going to get to those in 1 second. So again, when I see a straight up move, a quick pop, just like I did with that, what was it, Beyond Meat a couple weeks ago, get that initial pop, get out. I may decide to recycle back in, especially if there's a pullback and the stock market holds up. Now let's talk about the stock market. So we keep having that resistance level hit, slightly taken out now on QQQ. We're a little bit above there, and I'm going to say that's bullish because that's what's capped every rally for the last since Friday's sell signals. The sell signals are still very much intact. I'm referring to the primary trend line breaks on QQQ on the daily chart. That's the primary uptrend line off the lows back there, the April lows, big bearish engulfing candle. So to me, nothing technically changes unless we clear that out. And I want to talk a little bit about the small cap. Somebody asked me about that today. So this is, just remember, that was the biggest down day in a year. You're coming off one of the hottest rallies in a while. Dip buyers are going to do what they do. As I've been stating, the next sell signal, remember, don't mistake an objective short entry, which is a pop back to resistance, as a sell signal. That's not a sell signal. It's the opposite. It's a rally back. There are two ways to objectively short a stock or add to it. It's either rally into resistance or break a support. Now, we've taken the resistance out, so I'm going to say it just clearly. Unless we fall back below that level, I don't think it's objective to short right here because we're not at resistance and we don't have any sell signals. What I've said before remains. We need to take out Friday's lows to open the door to the deeper targets there. So far that looks fine. And if you look at how the market peaked back the last time it put, remember that was a bearish engulfing candle. The last bear market, or whatever you want to call it, corrections, again, semantics, whether you define that drop in 2022 is a bear market or a correction. But we did the same thing back then. I'm going to zoom in nice and tight for you and just show you. And I highlighted at the time. We had a bearish engulfing candle followed by a trend line break. And then from there, after the trend line break, the market went sideways for about a week or so. And finally, it had to take out that recent low to get some more downside, took out the 50s. And again, it was coming off a very hot rally. Pavlov's dogs do what they do. They were buying dips, but it took a while. That bearish engulfing held. It marked the top, followed by a bear market. But the market went sideways for a while, and it was only once it failed to make new highs and then took out. See, that was that trading range I showed you. Did the party really get started? So that in itself, again, is similar to what happened back there. I'm talking about what's happening right now is similar. I'll tell you the one thing today why I would not add, even though this morning I showed you we were at that level in the futures. Again, we just took it out. So now it's no longer an add to or initiate or add back any short positions. And the thing I don't like that's bullish in my opinion, as long as it holds. Again, I want to see how this week finishes, is the financials. So if you recall, financials had really nice support here. We broke down. It was a solid breakdown on Friday. We remained below it. And then a lot of them reported recently we recovered that level. So that I can spin this as no other way but bullish, especially JP Morgan, the leader. Again, the pre-earnings breakdown, take that with a grain of salt. As I said, yesterday's earnings, it was down, closed back on a back test of the trend line. But right now, as I speak, we took it back. So to me, because this is the second largest sector in the S&P 500, with the data blackout from the government, this is probably the best insight we have right now to the health of the markets. And as of now, JP Morgan, the leader of the group, has taken back that trend line. So to me now, despite what was going on in pre-market, this is a no-go because that's no-go adding to any more shorts because that is net bullish. So just kind of, I'm personally going to sit tight, see how the week finishes. Maybe this is going to be a whipsaw. Or that definitely was. Again, that was earnings induced, a lot of volatility and noise around earnings. And so you still have the divergent high that was put in. We're still well below that. Let's see how the week finishes, especially the financials. And, I'm watching them all. Visa, MasterCard, Bank America. Again, Bank America, most of the financials are below those recent highs, but they're rallying after earnings. And that is, again, I showed you XLF, the second largest sector in the S&P 500. So we're going to need, I need to see that one roll over. And as you can see, that was a clear breakdown right there into earnings, sold down, and now we recovered this trend line. So this right here, again, is what's giving me pause. And just saying, sit tight. Sit tight. We're still below those bearish engulfing. The trading plan's a plan on QQQ. Somebody asked about IWM. IWM replied today is currently back testing. This is the trend line, the primary trend line, comparable to the one that QQQ just broke down below off the April lows. And as you can see, it was a very well-defined trend line. Back test, had a nice rejection, which I like to see. That was on Friday. But they've gobbled that back up. And so that yes, it is a back test. And what I told subscriber in the my reply, I'm probably going to make this, and I will do it right now, make it official, stop on a weekly close because I want to see how the week finishes. This is a lot of earnings noise. There's a lot of volatility. The VIX is still has woken up lately. We're going to look at the VIX real quick. And remember what I've been saying on the VIX. No change until unless the VIX takes out that 22-ish resistance. That was a big level there. Told you it would be the first target. So far, it stopped that rally that first day. Rejection off that level. Hit it again yesterday. Another rejection. It's very simple. Now I expect it to go. This is still one of my favorite trades. Just again, right now, we need to see the financials fall back down below those trend lines and the breakdown levels that they just recovered. And you need to see QQQ take out the recent lows. Most importantly, not erase those bearish engulfings by moving back up and printing solid closes back above those levels. So that's it. Otherwise, like I told you in recent videos, sometimes the VIX wakes up, perks up, and then it's a short brief. And I'll tell you, if that happens, the market powers the new highs. It just shows there's still a voracious bid in stocks right now. Again, we had some very clean, clear, powerful sell signals on Friday. Those sell signals are still intact, but we need to get the next technical events to make a case to increase or add to short positions. And that's simply, again, number one, a break of the recent lows, Friday's lows, in just about everything. But mainly, if you want to keep it simple, okay, remember when I was doing the video on Friday, started out that video, and all of a sudden you could hear in the background alarm bells going off one after another. And I said, hey guys, something's going on. And I warned of that for weeks, months actually. I would do these videos, I would set the price alerts, show you where I was setting them, encourage you to do the same, and tell you there's going to be one day where all of a sudden those alerts are going to be going off like popcorn. And then you have to move fast. And there was plenty of opportunity to get in short that day and short that big 4% plus drop in the NASDAQ because of all those alerts. Like I said, would be going off around the same time. Now, I'm going to keep it even more simple for you. One single alert, this is what I've been saying really, but a break of Friday's lows. So you just put I'll put a line there. I'm going to move this, borrow that line, and set a price alert. So that right now is really the only alert that matters. When that one goes off, it means you're going to have taken out Friday's lows. So what that means from a technical or psychological perspective is all the dip buyers that have come in and bought the drop off that high right there have been taken out underwater. And that will be, in my opinion, a sharp knife through the heart of the bulls when that happens, if and when that happens. So it's simple, kind of in wait and see mode. Like I said, if you short or go long here, you're kind of in no man's land. You're between, you're down below support. And as I said, the day we broke down, I believe one possibility, we could back test the trend line, but do you want to ride that out? So that's why, like I said, any short position now, kind of sit tight, wait for those next sell signals. We did have an objective short entry this morning, and we made today again, guys. Here's the thing: if we fall back, let me just add that we fall back below there, then that was a failed breakout. I don't think anybody could argue if you don't understand technical analysis. I've been highlighting this every day since Friday, the kickback to that resistance right there. So very few can deny, nobody that knows what they're talking about can deny that's not a significant resistance level. So just like the financials, that have recovered in reverse, if we fall solidly back below there, then this proves to be a whipsaw failed breakout. And then we'll probably go back down to and below the range. You don't do this very long. This is what I call, this is a function of the elevated VIX right now. Remember, we had some very powerful sell signals on Friday. They're still very much intact. And this is what you get. This right here, let me just spell it out for you if you're new to trading. You had and this is just intraday. Now, it doesn't even include the additional losses we had in the after-hour session on Friday. It was another 1 point some% drop. It's a 4% drop in QQQ, followed by a 2.5% rally, followed by a rejection there, 2% drop, followed by a almost 3% rally. As you can see, when you look back, there's nothing like this in quite some time. We had a little bit of volatility back here, but it's been a low grind, slow grind market. And so make no mistake about it. Again, it's very simple. That is a function of this. So if you are new to trading, and especially if you're an active swing trader or even an investor, and you don't know which way to go, up, down, left, right, long, short, just understand that you have to expect that when the VIX wakes up, volatility is high, and as long as it remains elevated, if it falls back down to this level, this trend line again, or especially below it, that will almost certainly coincide with a breakout of new highs, negating the recent sell signals, and you're going to see a return of low volatility. The commercials and the pros will start selling volatility again. Volatility will abate. You won't see these big multi-day swings. You could even see a blow off top in the stock market if that happens. As of now, that hasn't happened. As of now, the VIX remains elevated, but again, as I've been saying for the last since Friday, really, this is a level you need to take out. That's the first resistance level, and it was a damn good one too. And so they're selling volatility there, and which involves buying stocks. But again, it's been one day up, one day down, one day up, one day down. And let's see, whoever wins this battle, bulls in the stock market win if the VIX does that. Bears win if they can just pop 22 and run, hold above it. Not an intraday little whipsaw through it. Solid move. If it's 2 p.m. or 1 p.m. and you're up here to my next target around 25, it's safe to say that's broken out. And then, like I said, just don't underestimate the VIX when she wakes up. Here's where she woke up back there. Had a couple days of a corrective action, and that would have been with the stock market going up, dip buyers buying stocks, and then an explosion higher. So that is still what I favor. But again, I'm going to let the charts dictate when to go full hard short, or stop adding, or even more importantly, when to just close out the shorts. I have no problem, as I talked about, taking shots on the market, taking shots on the VIX, and if they don't work out, get out and just wait for the next setup. We haven't missed one of these yet. We've been positioned in or even in front of the breakouts on all these big moves up in recent years. And right now, like I said, this is still one of my favorite trades. It's just not an all-in moment right now, but will be if we can take out that resistance there, and also take out the recent lows on from Friday's lows on pretty much just about everything, including but not limited. QQQ is the most important, like I said, if you want to keep it. I hate to oversimplify things, but that should do the trick. Of course, I'll be watching the financials. And then just to go back, let me loop back to that BDC ETF that we did. So on this one, remember, for all the reasons stated back here, something in the charts told me that there was a problem in this sector, and this is where I first started covering it, long before we broke down, saying this would be a sell signal and problem, showing that something's going on there. And it took all the way to down here until those, it was tricolor first, and I thought the markets were underpricing the risk from tricolor, and I was correct, at least in this sector. And then we had the other one, was it First Brands, the big auto parts supplier. Sorry, just the name is leaving me right now. And so that was all there. We called it down right to that fourth target. Told you Friday I started buying it there. Then Monday we even had it up, took a full position, and made it an official trade idea. But at this point in time, and again, right now, that is still my preferred scenario, that the stock market has a good chance at put a top in on Friday. Like I said, need to see a little bit of need to see that fade on the financials, need to see IWM get rejected. There's some work to be done, but if that's the case, then we may very well, the bottom could fall to this sector. In other words, the next shoe could drop any moment. And so I don't feel comfortable. So the way I explained it today, I booked a 6.5% profit. That's not a lot, but if you make 6.5 in 2 or 3 days, there's a term I made up called velocity. If you can do 6%, let's just pick a round number, 5% a week. Well, that's, times 4, that's 20% a month. Multiply that out by 12 months in the year, and that's not even compounded. You're doing great. So, it's just like those, some of these trades, I like to get these bounces off support. And when I've milked out what I think, especially with no corrections yet, what I call the easy money, we're halfway to, there would be a 12% profit if that was my original T2 right here, that $15 level. That's going to be, I think, measured out to be 12% if hit. Let me grab again. Yeah, right about there, 11 something. So that's it. So do I want to risk a sudden reversal or giving back some profits? In some cases, guys, what I'll do, and I just didn't feel like doing it today, I just want to have that dry powder if I want it. I'll set a relatively tight trailing stop, and if it gets up to T2, then I'll raise my stop up here. And if it keeps going, then I'll raise my stop up here. That's another strategy. Again, to me, just want to get this out. I'm focusing on my taxes today, so I'm not watching the market closely. It won't be after this. And so that's fine. But I left the trade on as an official trade idea. But as I said in that update, you want to obviously raise your stop. There's no reason to let a nice quick gain like that turn into a loser. So whatever your entry price is or was at this point in time, I think at minimum you should raise stops to entry to protect profits. Know that can only protect you so much. If there is a credit event, something big happens in this, and it gaps down, let's say right here, and your stop's right here, well, a stop loss order will continue to sit there. I'm sorry, a stop limit order will continue to sit there. A stop loss will get filled. Stop limit will stay at the price unless you come back up there. So you could continue to see this one bleed off. So in other words, I don't think that this sector, the business development companies, private credit, is out of the woods yet. Speaking of that, I want to check on PSP, private equity. Yeah, private equity, still put in that divergent high, took out the major primary uptrend line there, and is still well below it. So this one hasn't really undone anything. The only thing is it's trying to recover its 200 days, but I don't really put a lot of weighting on a stock that slices through the 200 days very frequently, like they're not even there. Some stocks, quote unquote, behave better off the 200s than others. And this is not a stock, of course. This is a ETF that tracks a sector. All right, that's about it. So only changes today. New target on BIZD if you are so interested to book the quick profits, and also IWM. I'm changing that out because I do want to see how this week finishes with volatility high. That leads in earnings and really getting going here this week. That leads to increased whipsaws. Whipsaws are false buy and sell signals, meaning brief breaks of support or resistance only to see prices reverse back down below. And when I see that kind of volatility, especially around Fed days and earnings, big earnings season, big earnings reports, or an earnings week like this, then I'll kind of keep things light, widen the stops up a little bit to kind of not get clipped out in the noise that I call it. All right, so I'm going to wrap it up there, get the video out to you, and I should be back this afternoon in full swing. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.